So in our last video, we dove into the 3 C's of lending. That if somebody wants to get immediate business financing, they need to have cash flow, good credit, or collateral. We even dove in and dissected this cash flow financing. We looked at the kind of money they can get if they have bank statements versus the kind of money they can get if they're proving their income through tax returns. In this video, we're going to talk about if they have good personal credit or a good credit personal or a good credit partner or guarantor, or if they have collateral. So if somebody in their organization or them individually have good personal credit that they want to use as a signer, or they have collateral, then that opens up additional financing options, which we'll talk a little bit more about. So if they have good personal credit, then that opens up something we call unsecured financing or unsecured business financing. And this is where they can get about $10 to $150,000 in financing. And what's great about this program is that they don't need collateral. They don't need cash flow to qualify. All they need is good personal credit or a signer that has good personal credit. So this means even as a startup, they can get this program. And because it's so easy for somebody to get with only having good credit, even as a startup, this is a very, very popular program that you're going to see a lot of your customers actually come in and qualify for. So they're usually going to get about 5 times the amount of their highest revolving limit account now. So we're going to look at their credit report. We're going to see whatever the highest limit account they have that's a revolving account that's in their name, not an authorized user account, that's in their name, not a home equity line of credit, the highest limit revolving credit card account they have, and they're usually able to get about 5 times that amount. So for example, if somebody has a $20,000 limit account on their credit report now, 5 times that's about $100,000 in financing that they very well might qualify for. Now, a benefit of this program is that these accounts report to the business credit reporting agencies. So not only are they able to get a lot of funding quickly, usually takes about 2 to 3 weeks for this program to fund and put the money in their hands, but they also build their business credit at the same time. Now, this is different credit than what you're going to find in the credit builder section of the finance suite. Remember, in the credit builder section of the finance suite, that's when we're building in credit that doesn't require a personal guarantee. It doesn't even require a personal credit check. We consider this type of financing actual financing versus real business credit because yes, they will need to supply a personal guarantee. Yes, they will need good personal credit to qualify. But a benefit of this program is that they're also building their business credit at the same time because unlike a credit card they may go get at their bank, these cards report to the business credit reporting agencies, helping them build business credit at the same time. Now, they're usually going to get 5 different business credit cards. Okay, so this does a couple things for them. First of all, they're not going to get a credit line unless they have tax returns. And even if they were, the credit line's equivalent to the net profits they show, which is usually a small amount. So in this case, to get them the most amount of money, we put them with a source that specializes in getting these kind of really phenomenal business credit cards. And this source can usually get them 3, 4, 5 of the best business credit cards that are out there. If the customer went into their own bank or tried to go secure a bunch of business credit cards on their own, they wouldn't have much luck. Their own bank maybe would only give them 1 card, equivalent to the highest limit revolving account they have on their report. And if they tried to go to other banks and other sources and get more and more credit, they would fail. Because when these sources see a bunch of inquiries on their credit report, they start diminishing and diminishing the amount of money somebody can qualify for. And usually after somebody has 2 or 3 or 4 inquiries, they're not able to get any more credit. So what's awesome is we're putting them with a source that specializes in getting on the most and the best business credit cards. And this source will get them 5 business credit cards, usually somewhat equivalent to their highest credit limit account they have. Now, not only does this get them about 5 times the amount of money they get on their own, but it also helps create competition. When these start reporting to the business credit reporting agencies, then it's easier for the customer to go back to those card issuers and go, hey, I just got this other credit card. It has a higher limit. Will you consider raising my limit? Where they often do. And again, the actual source that helps them secure the cards is the same source that will help them with that negotiating process to get even higher limits after they get their initial approvals. Now, another benefit of this is that they get 0% rates for 6 to 18 months. And then after that, you're usually looking at normal credit cards rate. Okay, so 0% rates for 6 to 18 months. Then they're looking at normal credit card rates after that. So, normal credit card rates are 5 to 30% on consumer and business credit type of accounts. But what's beautiful about this is the 0%. 0% for 6 to 18 months. A lot of the people you're going to help with this program are in the startup phase of their business. They're in the early stages of infancy for their business. And in doing so, this is where it's absolutely most important that they have the lowest payments possible. And you can't get any lower payments than paying a 0% rate for 6 to 18 months on the type of financing they secure. So you're starting to see the benefits here. They can get this program even as a startup. They can get up to $150,000 as a startup. That's crazy. That's just only available through a program like this. They're building their business credit at the same time. They're getting 5 times the amount they would get at their bank, or 5 times the amount of their highest credit limit account. They're getting 0% rates. Pretty phenomenal program, which is why it's one of the most popular funding programs that we offer. Now, the actual source that helps them secure the financing that we get them set up with charges a 9 to 12% fee. So here's the deal. We've really been through, I think, every source that offers this kind of financing. There's not a lot out there. There's about less than 10 reputable companies that offer this kind of financing out there, and we've used them all. And we only work now with the ones that are the best. What do I mean by the best? The ones that charge the lowest fees and get historically the most amount of money for the customer. They also give the customer the ability to have a CRM to monitor their progress in real time. They don't charge upfront fees. There's a lot of things that determine with us the best kind of source. But the best kind of source ultimately is somebody that charges the lowest fees and gets the most amount of money for the customer. So normally the industry standard's about 12%. If a customer goes out and happen to find one of the less than 10 sources that offer this kind of program, they're going to pay 12%. But since we do so much volume, our sources give our customers a discount where they're usually going to pay, 9-10% rate, usually in fee, depending on the actual risk of the deal. So the actual fee will range from 9 to 12% depending on the risk, but usually they're going to be somewhere around the 9-10% range. They can get less in some cases based on really low risk. Sometimes they may pay more. Sometimes you might want them to be charged more so you can make more if you're part of our direct funding program, but typically they're going to get a fee for about 9 or 10% unless you want them to be charged more to make more on your end as part of our direct funding program, which is something you'll learn later on in our training. But the fee is about 9 to 12%. Now, just like an SBA loan, this gets rolled in to the actual financing. So what's going to happen is they're going to come in, we're going to qualify them, we're going to get them with the actual source that's going to help them secure these cards. The source is going to do a consult call, give them documentation that shows a range of what they think they can get them approved for, 80 to 100 grand, for example. The customer says, yes, let's do it. They sign off. Then they start securing the actual cards. Takes about 2 to 3 weeks from beginning to them actually getting funding. As their cards start to roll in, they'll get invoices for each one of those cards for the actual fee. So that means they can actually use the cards they get to pay the fee that's being charged, which is absolutely awesome to be able to do. Just like an SBA loan, that they have a fee that's rolled in. With this kind of financing, they get the fee and they're able to roll it into the actual financing that they're securing. So when it comes to qualification, somebody has to have really good personal credit to qualify, or a guarantor. The guarantor could be a friend. It could be a family member. It could be a business partner in the business. It could be somebody that wants to invest in the idea or the business and maybe get an exchange of equity. It just needs to be somebody with good personal credit. We have a lot of clients that use their own personal credit to qualify. We have a lot of clients that have a partner, a friend, a family member that wants to be a signer, and they use that signer as a guarantor to actually qualify. Either way, you need somebody with good personal credit. What does good personal credit mean? Well, no recent derogatory items. Really preferably no derogatory items on the credit report. Definitely nothing within the last 12 to 24 months. They really should have a 700 credit score. If you have somebody that's close to that, 660, 670, 680, well then you still might want to get them submitted, or they still might qualify for financing if they do some things to their credit. So for example, if they get with a credit repair company, maybe you are a credit repair company and you're helping them fix their credit, so that'll help them qualify. If you're not a credit repair company, then we've got internal sources we've got sources we can refer them to that are partners of us, partners of ours that sell the finance suite to help them fix some derogatory items on the credit report that are inaccurate. Or we can help them get their limits raised with their credit issuers, or we can help them transfer balances. If they have one credit card where their utilization is really high, we can help them transfer the balance to different cards to offset the utilization being high on that one card. All these type of things will bring up the scores. So somebody's going to have good credit, 700 or more to qualify. But if they're close to this, there's still some advice and help we can provide them to help them get to that point so they will qualify. But you got to keep that in mind. Don't bring somebody in with a 650, 660, 670 score and tell them they're going to qualify. That's not accurate. They need a 700 to qualify. Whether or not you or us can help them get from 650, 660, 670 to 700 is a whole different conversation that we're willing to have with them. But again, they need a 700 type credit score to qualify, or higher is what's preferred. And if they're close to this, then there are some things we can help them do to possibly get to a point where they'll qualify. They've got to have open revolving limit accounts now. This makes sense, right? They're going to get about 5 times the amount of their highest credit limit account. So in order for them to qualify, they've got to have an actual revolving credit limit account, preferably with a limit of 2,000 or higher. They can't come in with only authorized user accounts and qualify, right? They've got to have some credit cards of their own with limits of 2,000 or higher. They don't need a bunch. If they have a mortgage or car loan reporting on their credit report, they may only need 1 or 2 credit cards to be able to qualify for this program. If they don't have a mortgage or car loan, then they're going to need probably 2 or 3 or 4 other type of accounts on their credit report to qualify. They need to have some kind of depth of credit. They need to have some kind of revolving account that's not an authorized user account, preferably with a limit of 2,000 or higher to qualify. They need to have low inquiries, 3 or less in the last 6 months. Okay, so they can't have a lot of inquiries on overall or on each individual credit bureau. So we're going to look at the credit bureaus. If they have 4, 5, 6 inquiries in the last 6 months on any one of their actual credit reports or credit bureaus, then that would disqualify them. They need to have 3 or less inquiries with each of the consumer reporting agencies in order to qualify. They also need to have utilization that is 30% of their actual limits or lower. So if their credit limits are $10,000, then they need to have utilization of 3,000 or less. It needs that what they owe needs to be less than 30% of what their actual limit is on those accounts, overall and individually. So if they have one credit card, they have a really high utilization, and others they have really low, well then we can help them move the balances, or give them advice on transferring balances from the high utilized account to the lower ones to spread that out. But their individual accounts and overall needs to have utilization of 30% or less. So the next type of financing is collateral-based financing, and this is great because it offers lower rates than even SBA type financing you can secure. So with collateral-based financing, they've got to have some kind of asset, some kind of collateral to use to borrow against. It could be account receivables with the government or another business, a 401k, stocks, bonds, securities. It could be equipment or inventory or a book of business if they're an insurance agent. It could be purchase orders. So you want to ask everybody you talk to, do they have the cash flow? Do they have, what is their credit like? Do they have a credit partner? Do they have some kind of viable collateral? And then they might say, well, what do you mean? Well, do you have equipment or inventory or 401k or stocks? Commercial real estate, do they have an asset, not a personal home, but do they have an asset that's worth money that they can possibly use as leverage to qualify for financing? Now, in my experience, in a lot of cases, one, not a lot of people have collateral or assets. So you're going to find more people that have good credit or a good credit partner or cash flow than you'll find people that have collateral or assets. Two, you can often tell the type of collateral or asset somebody has just based on the industry type they're in. So if they're in financial services and they're a mortgage broker or real estate agent or an insurance agent, well then obviously they don't have inventory and equipment worth bunches of money and account receivables and purchase orders. Those are more people in the manufacturing sector or the retail sector. People in the retail sector that have stores with tons of inventory have inventory. People that are in the manufacturing industry probably have big pieces of equipment or inventory on the shelves or account receivables or purchase orders. But somebody that's in financial services like a real estate agent still might have a 401k, or maybe they have stocks, or maybe you're talking to an insurance agent that has a book of business they could use as collateral. So in a lot of cases, based on their industry, you're going to be able to tell what kind of collateral they have, but you still want to ask everybody what kind of asset and collateral they have, and you want to ask them these type of things like a 401k or stocks or equipment or inventory or account receivables. Give them some examples so they'll know what you're talking about. Now in the partner resources section of your back office, In the funding section, there's something called a funding program cheat sheet that gives you kind of an overview of each one of these individual types of financing, the rates, the terms, the qualifications, etc. I won't go into that on this video, but for this video, I just want to tell you that when you're talking to a customer about whether or not they might qualify for immediate financing, you want to ask them if they have collateral, assets, give some of these things as examples. If they do, they very well can qualify for financing. So that being said, now you know the 3 C's of lending. You know if they have cash flow, if they have good credit, or if they have collateral, what type of financing that opens up. We've talked briefly about the most popular types of financing that they may be offered. Again, there's all different kinds of other type of financing like Alt SBA and SBA loans that we're not really diving into here because you're not going to see those as often, but customers can still qualify for a lot of those type of financing. For this video series, I just wanted to go through the 3 most common types, which is collateral, cash flow, and credit, because those are the 3 types of financing you're going to deal with most, with cash flow and credit being the most popular and collateral being the least popular of those 3. So make sure you ask your customers the 3 C's. If they have the 3 C's, that's going to help you determine if they can qualify for immediate funding.